Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to do another quick review of velocity banking. So the reason I'm making this video is because I've heard on the internet people saying things like, "Oh, just replace your mortgage to line of credit and somehow that's supposed to make things awesome, right?" And that's actually not true, right? So there's nuances that we have to consider when we're paying off debt. And even if, let's say, your mortgage was the only debt that you have, I'm 99% certain you shouldn't replace the whole thing with a line of credit, and we'll go into that a little bit later. But if you have various types of debt, and I remember one guy actually sent me a spreadsheet, and he had 14 debts, and he was making good money, and he was broke, right? Usually, if there's a mortgage in there, the mortgage has to be paid off last, and I'm going to briefly explain why. And so I've never seen an exception to this. Now there may be an exception, but I've never seen one. Right? So we're going to talk about in general why we should never pay off the mortgage first. Okay? Like I know that's the one people are focused on because it's a debt that's tied to, America's most prized possession, which is a home, but it should be the one that should be paid off last, right? And so if we think about the mortgage payment takes up the least amount of cash flow out of all the debts, and that's simply because of the time period, right? So you have a debt that's based on 30 years, and a mortgage payment will only go up for two reasons. Whether number one is an increasing interest rate, and most Americans can associate that an increasing interest rate is bad, right? And number two is a decreasing length of time. So for some reason, most Americans cannot compute that decreasing the length of time will actually decrease your cash flow, and increasing it will increase your cash flow but at a cost. Okay, so the longer the time, the lower the payment. And I can just quickly show you through this loan amortization calculator. So if I have a 30-year mortgage, right, you just simply put 30 years, the monthly payment is about $1,200. Now let's say I get a 15 or a 10-year mortgage, right? 15 years. Okay, hold on, let me do that again. 15 years, that payment shoots up to about $1,700. Heck, let's even do a 2-year mortgage, right? So the longer the term, the less the monthly payment is. So let's just do 2 years, and you can see that's $8,000 a month. So obviously most Americans can understand. Oh, if I increase the interest rate, so let's say it's this 10%, my payment will go up, right? As you can see right there. Oh, but if I decrease the term, my payment goes up, and this isn't as well understood with just people in general because they just simply think, oh, the mortgage is bad just because it's tied to my home, and that's simply not true, right? So we have to consider that the longer the time, the lower the payment, because your average mortgage is about 30 years. So let's just redo this: 30 years. It takes the least amount of cash flow compared to the debt. Okay, so $1,200. But here's the catch: the longer the term, the more interest we have to pay. So it's always a trade off, right? So let's just go here. So if this is a 30-year mortgage, even though the monthly payment is extremely low, the amount of interest we pay in total is really high. But let's say this is a 2-year mortgage, right? This monthly payment is going to shoot right up to $8,000 a month, but look at how much interest we pay. Only 12 grand, right? So this is something that we have to understand and consider, but not a lot of people really talk about this, okay? So we want to pay off the debt in an order that increases the cash flow the fastest, and paying off the mortgage first does the opposite. So I'm just going to do a quick demonstration. And again, this is a velocity banking budget, right? So in order to do velocity banking, there's only two requirements. Number one, you need a budget, and number two, you need a line of credit as our main operating account. So let's just assume, we have a $300,000 home equity line of credit. It sounds crazy, right? But let's just assume for practical purposes, or not practical, non-practical purposes. What am I saying? For demonstration purposes, that we do just to demonstrate a point. Okay, so let's say we have all this credit card debt. We have $167,000 of credit card debt and a $300,000 mortgage. Okay, and we make great income. So at this stage, we're freaking out. Should I get rid of my credit cards first or should I get rid of my mortgage? Now, I remember hearing a long time ago Susie Orman saying credit cards are actually better than, let's say, a HELOC or a mortgage because, if you default on a credit card, it's unsecured and they're not going to take anything, right? I guess that's true. I don't know if that's really true or not. Can't they sue you or they'll ruin your credit, right? But in general, assuming that we're not deadbeats and we actually pay our bills and we have an income because we did not line our loan applications, we have to figure out which debts to pay off. And so some people think it's better to pay off the mortgage first. Okay. So we have a $300,000 mortgage at 1798.65 at a 6% interest rate. Now let's assume, okay, that the income is the same and the savings, again, this is one of the things that we always talk about with velocity banking is that we're not going to have any savings because our line of credit is going to be our new savings, okay? And then our main operating account will be this home equity line of credit for $300,000. Or we could, make it a little bit different from the mortgage because the mortgage is 300. I'll just say 310 just for demonstration purposes, okay? So we can do one of two things. We can pay off the mortgage first or we can pay off the other debts first, okay? But let's say we do pay off the mortgage first, right? So what's the actual strategy? The actual strategy is that you're going to put your entire paycheck into the line of credit, expenses out, and then we're going to have what we call our cash flow pay down our debt, right? And our cash flow is simply our income minus our expenses. Now, before we do some debt transfers, this amount we have in savings and our cash flow is exactly the same. So let's just go ahead and go over what the cash, what is the debt order payout that's going to increase the cash flow the fastest. Okay. And so here we really want to emphasize or do a deep dive as to why we never want to pay the mortgage first. Okay. So let's say we transfer the mortgage into the line of credit. So we have a $310,000, think of it as like a credit card on your home equity line of credit. And then we move the mortgage into that home equity line of credit. Okay. Well, guess what happens, right? This turns to zero. And you might think, oh my goodness, that's amazing because we went from $355, so let me zoom this, to $2,100 in one swoop. That sounds amazing, but you have to compare it to the alternatives, okay? So let's go ahead and take a look at this. And I'm just going to do a record this. So, when we do our velocity banking calculations, we have to calculate the next month and then the next month's balance, which is based on the previous month's balance plus the previous month's interest minus our cash flow. So 2154.17. And the interest is based on the average daily balance. So we get this interest right here. Multiply it by the interest rate of the HELOC, 0.1, and divide by 12, right? And so we have this $2,500 interest payment that we have to pay. And as you can see here, our cash flow is only $2,100, right? So this is why we don't want to just simply move a mortgage into a line of credit. Like, okay, $2,100 in savings. Does this mean we negative cash flow? Oh my goodness, it does, right? So we paid off the mortgage first, and then we negative cash flowed. Isn't that crazy? Right? But, okay, let's take a look at this. So that's scenario one, and let's actually write this right here. So if we pay off mortgage first, we get 2154.17, 251417 of cash flow, but it's actually negative because of the interest, right? And so and this also has to do with the debt to payment ratio called the cash flow index. So one of the things I want to introduce to you is how do we know that we should pay off the mortgage last? It's because of something called the cash flow index, which ignores the interest rate. So let me just do a quick Google search on the cash flow index. Okay. So let me take a look here. So basically, the cash flow index is the loan balance divided by the monthly payment. And so whichever loan has the lowest CFI number is the one you want to pay off first. It doesn't matter what the interest rate is on the loan. The most important thing is how efficient it is, which is what the cash flow index measures, right? So take a look here. And so what we're going to do is just do a cash flow index calculation. And this will tell us that, yes, we should pay off all the credit cards first, right? So let's go ahead and then just do calculations right here. 5,000 divided by 175. This one is 8,000 divided by 260. And then this one is 15,000 divided by 487.5, right? And as you can see, this is a really low number. So you could kind of think of this as a debt payoff system. I'm not going to do all of it, but let me skip to the mortgage, right? So 300,000 divided by 1798.65, right? So this should be a number, but ignore the dollar sign for now. 166.79. So you could see that it's like a ranking system, and the lower the number, that's the one you definitely want to pay off. And these are all going to be really low because, credit cards eat up a ton of cash flow because the interest rates are so high, right? And so let me just kind of go here. So you take a look here. A high number over 100 means the loan is efficient. A low number under 50 means it is efficient. So whatever has the lowest CFI number is the ones you want to pay off first. And since these are all these credit cards are under 50 pretty much, we just pay them off really quickly. Whereas this is 166 means it's a really efficient loan. So if we go ahead and pay this one off first, we don't actually cash flow because the interest will actually eat up our cash flow. Isn't that crazy? So we don't ever want to just simply move a mortgage into a line of credit. But let's just kind of do this. So let's just compare. So 300,000 for 2514.17 of cash flow. Okay. But we're not technically cash flowing because that interest of that $300,000 is so huge that it's going to make us go into negative cash flow. It's kind of a little bit, I guess, I don't know if deceptive is the right word. But again, oops, I'm on the wrong screen. But that we should never pay off the mortgage because the amount of payment that we get compared to the loan amount is so small that it makes absolutely no sense, right? That's what this 166 big number means. Now, let's do this. Let's move these all of these payments, $167,000 of credit card debt into here, right? 167,000, and then let's keep paying our mortgage as is, but because we transferred this credit card debt, take a look at what happens here, right? Now, this goes to $5,701, right? Is that crazy? So again, we have to think about the amount of cash flow or maximizing our cash flow and not just say, oh, put the mortgage into the line of credit. You saw that transferring the mortgage into the line of credit was simply a giant mistake from that end, right? That was a big mistake because we were technically going in the red, right? But here, if we transfer the credit card debt into the line of credit, we'll be okay. And so let's just do the calculations again. And so it's previous month's interest plus balance minus interest minus 5701.35. And let's actually record this. So for 167K, we get 5701.35. 5701.35 of cash flow, right? Okay, so now let's go ahead and calculate the interest, and we're going to do that. Average daily balance, multiply by the interest rate, and then divide by 12. And so now what we're going to do is I1, I2 plus 1, and then all we got to do is copy and paste. And if you take a look at this, right, now we're maximizing our debt payoff. and we're able to pay off $167,000 of debt in 34 months, right? All of these credit cards, 167K in 34 months, right? So don't just believe the blind mantra of, oh my goodness, we have a mortgage and we have a line of credit and we just need to move it into the mortgage or the mortgage into the line of credit. No, no, no. The whole point of velocity banking is to maximize this cash flow number, and if we're not paying off the debts in the correct order, we're not going to increase our cash flow. Okay? Like paying off $300,000 to only get $1,700 back is a pretty terrible idea. Whereas if you pay off this $167,000 of credit card debt to get $5,700 back, or whatever this number is, it's probably 5,400. That's a great idea, right? So there's these nuances that we must understand, and this is why you never pay off the mortgage first. But once it's time to, once you paid off all your debt, now you pay off the mortgage last, right? And the reason why we need to pay off the mortgage is simply because if we don't pay it off early, we're going to pay all this interest, right? So if let me do a $300,000 30-year mortgage at 6%. Look at how much interest we pay. If we borrow 300, we pay more than 100% interest after 30 years, right? You kind of see that the interest pretty much overshadows what we paid in principal. And this is pretty much like 100 and I think 16% loan, but we don't strike until the moment is right, and the moment is only right once we've maximized this cash flow number, okay? And whether you decide you're going to directly overpay the mortgage with your savings or use a line of credit, it doesn't matter just as long as we maximize this cash flow number, okay? Now, let's just go ahead and put it in to our velocity banking calculator to see what the results would be when we pay it off with our line of credit. But with this mortgage, again, we're going to do it in chunks and not just replace the whole entire thing. Okay. So let's just go ahead and put in our numbers. Again, this is a calculator provided by Renatus, which is where I originally first learned velocity banking from. And full disclosure, I sell their products and I make a commission off of it. I'm an independent contractor marketer, blah, 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 blah. All right. So now let's go ahead and put $300,000 as the loan. It's just a plug and play calculator. And then after 34 months, we got to figure out what the balance is. So 288, right? So 288, and then interest rate 6. What's the monthly payment? 1798.65. Right, okay. And then now what we're just going to do is put in our income, 10000. All right, and the chunk amount, we'll just put the same as our income. And then our expenses are everything except for that line of, except for that loan we're trying to pay off. So it'll be 2,500. So 2,500. Okay. So you can see here it takes us 3.6 years to pay off. Now, one of the things I'm going to really emphasize is that the interest rate is not as important as our cash flow number, right? So people might freak out and say, "Oh my goodness, why would I ever do this with the, let's say, a 30% credit card, right?" And to be honest, 97% of the time you wouldn't. What I'm trying to demonstrate is that the interest rate number is not as important as that cash flow number. Because let's say I change this, instead of transferring into home equity line of credit 10%, we charge this into a 30% credit card, okay? And do the velocity banking strategy. So 30%. Okay, let's take a look at this. 3.6 years, $33,000 of interest. Now let's see what happens if we change this to a 30% credit card. 3.7 years and $39,000 of interest, right? And if you use a credit card, I'm pretty sure you can get bonus points and stuff like that. I don't know if you ever saw the article about the guy who paid off a Tesla with a credit card and got $5,000 back in like travel rewards points, right? So you might be able to make some money with credit card arbitrage. I don't know, right? But what I'm just saying is that this interest rate is not that important compared to that cash flow number. And here's a crazy thing, right? So let's say I even have a lower interest rate, but I put this entire balance of the loan into that line of credit. So 288,961.67. This is pretty much going to double, right? 61,000. So even though you pay it off quicker, you don't necessarily want to move the entire thing into the line of credit at a higher interest rate, right? So isn't that crazy? But let me just go in here and move it to 6%. And so yes, if the interest rate is the same, it doesn't really matter. But let's just move 6.5, 7, 8, 9, 10. So as you can see, dumping the entire thing into the line of credit is a bad idea, and that's sensitive to the interest rate because there's not enough cash flow that gets freed up by dumping the entire thing from a lower interest loan into a higher interest rate line of credit, which is why you have to, if you do it in small chunks or pieces, it'll have the same effect as pretty much dumping it into a line of credit at like the same interest rate. Isn't that weird? It's kind of unintuitive, but it's what I learned from taking the Renaud's Velocity Banking classes. Okay, so hopefully we learned a good lesson today about why I'm not going to pay off the mortgage first. I'm going to pay it off last, right? And you know, I'm not giving you any financial advice, but hopefully this makes sense now that if you pay off the mortgage first, you're actually paying $300,000 to get $2,500 of cash flow. And this isn't even counting the interest in when using the line of credit as your main tool. And then here, if I pay off my credit cards first, that's $167,000 of debt to get $5,701 of cash flow. And we pay it off quickly, even if we take into account that home equity line of credit interest rate, right? Paid about $1,000 of interest every month, at least in the beginning. Whereas here, we're paying $2,700 of interest or something like that. So we're at technically negative cash flow. Isn't that crazy? Makes a huge difference about the debt order payoff. Okay, well, this is Crane Atlanta Mentorship. Have a great day and happy Saturday, I guess. And hopefully, all you crazy insomniacs aren't watching these videos in 3 a.m. at night. But who knows? Maybe I may make another video at 3 a.m. at night. All right. Have a great day, everybody, and we will speak next time.